I'm your host, Carl White, and for the next few minutes, we're going to do a deep dive on our guest today. Special guest today is Adam Candler, and Adam is an associate director for BKM Capital Partners. And Adam, you wrote a great article, which see, I get sneak previews, man. I'm so proud. I'm an official insider that I get to see the articles. Not much, but a couple days before they come out, and I read yours, and very interesting. So the title was Oasis for Capital, and it's the little headline here is regional lenders remain crucial to commercial real estate development. So welcome to the Scotsman Guide podcast, Adam. Great to have you here.
Hey, thanks for having me. Appreciate that.
So give us just like a 30,000 foot overview of what this article is about, and then you and I are going to go into a little deeper dive in this. And I think this is absolutely excellent. I think most people know me that I'm very well versed in the residential loan officer area and the commercial, not as much. So I'm really looking forward to this interview. So give us and kind of dumb it down a little bit for people like me. So who are you to write this article? Like, what's your background to write this article, and what's the overview of it?
Okay, yeah, I appreciate that. So I'm Director of Capital Markets, Associate Director of Capital Markets for BKM. We're a company that specializes in industrial, multi-tenant industrial real estate, sometimes called multi-use logistics real estate. And my job, easily and simply, is to be the point of contact for all the debt. So I go out and find the right lenders for our new projects as we do refinances, as we acquire properties, and maybe even if we have to do a recapitalization or an extension, et cetera. So my job is to understand the debt markets, how it pertains to industrial real estate specifically, but it has wider implications on the entire commercial real estate market. All
right, and give us a 30,000 foot view of the article.
Yeah, so since last summer, when the Fed started raising interest rates, we had a tightening in the credit market generally, right? So you have a pretty steep drop off on the commercial mortgage-backed security market, so that's CMBS, and as rates go up and the alternative cost of capital for going out and investors buying a CMBS bond versus buying a Treasury bond gets closer together. The volume of CMBS or commercial mortgage-backed securities goes down. So that's down 75, 80% since last year. That is a major source of liquidity for what's called the major money center banks, your Wells Fargo, B of A, JP Morgan, et cetera. And that has started a trickle-down effect of having there be less liquidity in the market generally. So you have, that's one side of pressure coming down on the larger lenders. The other side is coming down from the regional bank lenders, and that's exposure to most specifically office products. So I know that a lot of people know about the work from home and the office vacancies. A lot of regional banks and commercial banks, large commercial banks, have a lot of exposure to office, and that is done sort of by two different pieces coming at the same to the same center, really pushed lending liquidity down. That's the first part.
So I know in part of the article you talked about the recent failures of a handful of banks. Silicon Valley, I think, was the and obviously you know this stuff way better than I do, but I think it was the first one, and then Silvergate, and I think you mentioned, if I remember right, it was Signature Bank.
Yeah. So when I first wrote the article, Silicon Valley Bank, Signature Bank had not failed. So I had a chance to update the article. And then since I published the article, First Republic Bank also went out of business, so Silicon Valley Bank was purchased by First Citizens, a bank out of North Carolina, or South Carolina rather. And JP Morgan bought First Republic Bank, which is even larger than Silicon Valley. And yeah.
So how was the recent failures of these banks, and who knows, there might be more, I don't know, who knows, but what is the recent failures of them? What is the impact on that on the regional banking sector?
Yeah, so regional banks, we love regional banks. The commercial real estate world loves them because they understand the market granularly. We like to build relationships with a specific lender. Maybe they understand a certain product type. That's definitely been our experience here at our company. We have loans with large money center banks, and we have loans with regional banks. We like as I'm sure some of the commercial customers of regional banks feel like they get more personalized service, et cetera. That being said, they are very sensitive to deposits, right? So their liquidity is based a lot on the deposits that their banking customers, their commercial banking customers put in. If those deposits flee, as a lot have, and those deposits have flown to the money centers. That's most specifically with the recent failure of First Republic. They lost, something in the realm of $100 billion of deposits. Now, to the very, very short version of why that's risky, banks have long-term assets, right? So they have a 30-year mortgage at 2%, right? They have short-term liabilities, which means that they have deposits that can be withdrawn at any time. That mortgage cannot be called at any time. So there's a mismatch in what's called duration. And it can cause an old school run on a bank. And these last 3 bank failures are exactly that. They're it's a wonderful lifestyle, run on a bank. So, that's what's happened. And that has, of course, pushed down the ability for all lenders to lend on commercial real estate. And that is specifically felt in the office product. And then the products and then with some degree retail, and then multifamily and industrial still are favorites in the commercial real estate world.
So what are the differences? Like, how have the regional banks managed to maintain their role in the commercial real estate transactions despite these recent bank failures?
Yeah, so it's interesting, right? So you have the major money center banks that are, many of them have actually shut off lending and are only recently starting to build their lending world back up. I know they have all the money in the world, but they are worried about increased regulation. They do not have the source of liquidity in the secondary markets when I talk about CMBS. So it's been left to the regional banks. Now the regional banks are being pushed by a flight of deposits. So what they're doing, a lot of the regional banks are doing, to the degree that they are still lending, is they are asking for a depository relationship that is a covenant to producing a loan. And recently, in my experience, I've seen some of the regional banks really stretch and put through the market very, very competitive pricing, go put loans out as a way to buy depository business, and they're achieving it, and with us indeed.
Yeah, it sounds like the regional banks are really seizing upon this midst of to an outsider like me looking in of market inefficiencies. Is that a fair statement?
Yeah, that's exactly right. So as some of the major real estate lenders, some of the largest real estate lenders in the world, money center banks have essentially either slowed down to a trickle or stopped completely lending. The regional banks said, okay, we're going to step in and take, that we can buy customers that we would normally never get a chance to get, right? So big institutional level, real estate owners and operators, the regional banks are able to go buy that market share. Now, they're buying it and also requiring a, relationship business, if that is like associated business, like investment banking, purchase of derivatives, and then just good old fashioned treasury management deposits. And so even though there are, worries, and some people are a little bit worried about the banking industry in general, they're just saying, okay, we're going to provide this, asset level credit in exchange for the kind of relationship business that would normally go to JP Morgan.
Got it. Hey, I gotta go off script here just for a second. How in the world? So what something about you that probably most people don't know is you used to be in the Navy, like a search and rescue diver off of helicopters. How in the world did you get into banking after that? I just got to know what that flow is somehow. It's been bugging me here for a few minutes.
Okay. Yeah. So 20 years ago, I used to be cool. And since then, I have just, as I've become, now I'm 40, you get less and less cool every year. and then one day you wake up and you're in real estate finance. So it's just one of those things. It's a little step, a little you chew away at the coolness a little bit by little, and then you wake up one day and you have zero.
I can tell I'm not the first person to ask you that question. So, brother, I think both roles are pretty darn awesome. So
I like this a lot. This is really great.
Yeah, I get that. So so why are in the article you talk about, which is a fantastic article, and if you're listening this day, make sure you go actually and look at that. It's the May issue 2023. Why are regional banks more willing to lend to the local borrowers? You talk in the article about how the regional banks are a little bit more willing to lend to the local borrowers. Why is that, and how does that affect like loan approval rates, which I'm assuming is going to be higher?
Yeah. So if you have your non-institutional real estate owners, right, a smaller group that doesn't have a huge balance sheet, gigantic track record, to get your start to move and start building your portfolio, that almost always starts with a regional bank relationship. And that's because, this guy that's, for example, there are banks, regional banks focused in Phoenix, and they understand that market. Maybe this person has a good track record on smaller deals. And, in a lot of ways, and this is sometimes to the detriment of your regional banks, they graduate up into the majors. And, these regional banks try as best they can to say, hey, we have this good relationship. We understand your business model. I'm not a gigantic loan originator that oversees, the West Coast or the Southwest. I'm here in Phoenix. And, for the same reason that not every single person in America is a, Bank of America or Wells Fargo customer. A lot of us are regional bank customers. We like that personal use. And yes, because that loan officer and those credit officers understand a specific granular market, maybe better than somebody that's, sitting in an office that's not in that city. They have a higher likelihood of understanding that business model and approving those loans.
Yeah, brother, you're right there. I've definitely noticed that we just recently switched over to a regional bank for our me and the lovely Mrs. White, our personal banking, because we were told to wait in a line at the let's call it a big box bank, and yeah, definitely get different service at least we did on that particular day. Hey, so let me ask you, what should mortgage brokers consider when evaluating which regional bank to partner with? Like, so when I'm looking at these regional banks, what do I use for information to choose?
Yeah, great question. The way that it's funny, because a lot of people have tried to aggregate this into the cloud and turn this into a tech product. And, maybe I'm old school, but I think that at the very bottom of it, it's making phone calls, communicating with people, speaking to them either on Zoom or in person, describing to them what your or your client's needs are, getting recommendations from them if they're not the right fit. I just feel like, what's put up on a website or what's in a spreadsheet never tells the story properly, and people have only, a limited amount of time bandwidth. If you can say, hey, I have a client that has like 4 apartment buildings, they're looking for a refi and they want to take it, pull some cash up, buy a fifth one. Are you going to send a bunch of blind emails, or are you going to set up 5 meetings? And I would say, look at the local players in your market. If you're in Phoenix, your Western Alliance is, very strong in Phoenix. Washington Federal, if you're up in the Pacific Northwest, maybe you're in Southern California, there's a lot of banks down here that really understand, your Alhambra area banks. They really understand that market. There's banks that are down in the North County, San Diego. They're going to get that. They're going to stretch to win those deals, and they're going to stretch to win those clients because they want their associated business.
Yeah. What trends are you seeing in the article? You talked about the difference in, maybe a draw toward short-term financing and interest rate protection. What trends are you seeing in terms of the borrower's preferences for short-term financing and interest rate protection?
Yeah, so right now the cost of debt is more expensive than it's been really in my entire career, right? So the interest rates have gone up, pricing for bank debt, pricing for life company debt, and pricing for private money or debt fund debt is very, very expensive. So does that mean that all transactions are going to stop, right? if we think that interest rates are going to start maybe teetering off or coming down a little bit, you don't want to lock in a fixed rate loan at 5 years today, right? Which is another reason that the fixed rate CMBS market has cooled down quite a bit. So I still want to buy a property. I'm going to get a loan, even if it's more expensive than I would prefer. I'm going to put in, lock in like a 12 or a 24-month term, execute my business plan, maybe get the value, get the net operating income up, put it into a lower leverage bank loan that gives me a bit more yield, and I'm not locking in something in the 8.5% range. That I have to live with that loan in the event that interest rates do come down, which we hope they do.
Yeah, well, I think we can. It does look like it's indicating in that direction. Just kind of what you said, that in the over the, let's say, I don't know, the next 2 years, a stabilization of interest rates. What do you think the stabilization of interest rates could mean for the commercial mortgage market?
Yeah, I want to talk about that. Let me actually refer to a different point, because the interest rate protection, right? So anybody who works in commercial real estate or has had to place interest rate protection knows that something that literally cost $15,000, $5,000 18 months ago can cost $250,000, $500,000 today. It's become a gigantic line item, and something that's actually even killed deals and made them not pencil. So, two things that are involved with an interest rate hedge. It's essentially just, locking in an interest rate at a certain amount of time at a certain strike rate. So, you're not paying interest above that strike rate, call it like 5%. Now, there's two parts to it. The amount of money that we expect to, get returned by that derivative, call it its intrinsic value. And then what we think the volatility value is, and that's based solely on the uncertainty of where interest rates are going to go. Right now, if you buy something at a 5 strike, which means that you think that interest rates are going to go above 5, you're paying mostly for volatility. So it's this very, very expensive product that may not net you much return. So a lot of people are trying to buy those as short as possible, because the shorter period of time you buy an interest rate protection, the less volatility you're paying for. Anyway, just wanted to get onto that, and then I'll answer your second question, which could you, if you don't mind repeating for me, I'd appreciate it.
It was like over like with what most people think there's going to be a stabilization of the interest rates. What does that mean for the commercial mortgage market?
Yeah, so I have a group of friends we all went to USC together, and we have a running bet on where interest rates, the 10-year Treasury, is going to be at the end of the year. I have my money on 3.5. I think I'm going to win. We have guys think it's going to be 4. We have a couple of insane people who think it's 2.5. The loser has to buy dinner. So, good luck to all you guys. I'm certainly not going to lose that. But the overall thing is, none of us believe that interest rates are going to go back down to your sort of COVID levels. That's very, very low. We have short memories. We all got used to them being essentially at zero. Deals all kind of, went into place as if interest rates are going to be zero forever, money's going to be free forever. We think, a more healthy stabilization is going to be in that, like 325 to 425 range. And what does that mean for deals? That it means that prices and cap rates will have to stabilize, so that the debt allows the cap rate and the NOI of a property to provide value to somebody, on a risk-adjusted return. So. The very short version of that answer is prices will have to fit the new interest rate regime. Yeah.
So when mortgage brokers are looking, to start using different regional banks, and I guess for borrowers too, how can we identify which regional banks are under less stress and better position to offer financing? Like, how do we pick who?
Yeah, that's a really good question. I don't necessarily have the answer to it. Interestingly enough, if you were to go back to 2 years ago, maybe 3 years ago, First Republic, which is a bank that was just assets wiped, stock wiped out, and sold to JP Morgan. They had one of the strongest repayments and one of the lowest default rates on their loans. They had some of the most wealthy Americans as their customers. Mark Zuckerberg famously. And you would have thought, well, this is just a very Tony bank that has a very wealthy clientele. What's the worry? They're as strong as anything. Look who their customers are, and their duration risk, their exposure to uninsured deposits, and a couple months, from March until today, they've went down 100% in their stock value. So some of the things that we are now looking at are uninsured deposit levels. Their exposure to long-term bonds versus the likelihood that they'll have flight of capital coming out of their bank. And so yeah, it's difficult to know which banks are strong, which banks aren't strong. That being said, everyone who is a borrower from First Republic is now a customer of JP Morgan. So were they wrong to go get a First Republic bank loan a year ago? Probably not. They will now have a different servicer to go communicate with, maybe even the same person. But yeah, I think that it's difficult to say exactly which is the right bank to look for. I would say, like I said earlier, look for the person who understands your market.
Yeah, I get that. So, Adam, what have I not asked you today that I should have?
Let me think. I would like to. Yeah, I want to talk about product type. So,
All right.
Obviously, office is the dirtiest word in commercial real estate. It's so bad that even if you have some of your industrial square footage as a piece of it associated with, that tenant's administrative function, they're starting to count up all the space that's used for the bathrooms and used for the, the front office for, a 5,000 or 3,500 square foot tenant. I mean, like, well, you have a 35% office build out in this unit, and then in their minds they have a 4-story suburban office building growing out of your industrial center, like a ward or something.
Yeah.
So anyway, that's we are worried about office product and work from home and the return to office, and no one knows what we're going to do with that asset class, and I don't either. I've elevated possibly using all of the large office buildings as areas to play laser tag, as a perfect floor plate for it. Maybe laser tag becomes the most popular sport in America, and we can use all the office space for laser tag. But until that, no one knows what to do. Other than that, apartments, I think, are still, the strongest asset class. Everyone wants them. There's a housing shortage, and people are having difficulty buying houses with interest rates being where they are. Right below that is industrial, multi-tenant industrial, which is where we work. And, we think that it has good strength against sort of market headwinds. The middle child, the Jan Brady of the real estate asset class, is retail, which is coming back in a big way. And I think that a lot of retail centers are going to do really well. And then I think the sleeper is hospitality, which is, I think, going to come roaring back, and we're all going to forget. We're all going to remember why we love hospitality asset class.
Yeah, I think I mean, obviously I'm not versed in this area as you are, not even close, but I think it's going to, like, the return to office space. Man, I think we've moved on. I really do. I think we've moved on from that. And I think there might be a little bit of a bounce back, but I'm just looking just in my local area here in the Tampa Bay area. You're in the Newport Beach area. I'm over here in the Tampa Bay area. And it's we have an office building here downtown where I operate my business from. And boy, we, a lot of the tenants out of the building left, and I don't know if 2/3 left, maybe 1/3 of them came back, maybe. And I don't know. I saw the same thing in my own team, that we started working more remote. We pulled back a little bit and brought some of them back in because we found we got better work where they're under roof, at least some of the positions. And, frankly, some of the positions didn't really seem to matter. So, yeah, I was just getting ready on a personal note. I was getting ready to buy a commercial building here about 4 months ago, something like that. And I reallocated the assets to another area. I think the office space is going to be challenging, which, anytime, I think you mentioned this in your article, anytime there's a challenge, there's an opportunity, and it's just figuring out who and how to angle yourself best for that opportunity. Which I'll leave that as my kind of closing question here. What's the big opportunities here for the person that's listening to this today, which is your commercial mortgage broker? What's their big opportunity today?
Yeah, I think that right now, when there's a big shakeup, that's when your commercial mortgage brokers really shine, right? So we think it's when everything's humming right along. It's not. I started my career on the brokerage side. The first person who ever hired me in this business, he got his start during the great financial collapse of 2008. He's wildly successful partner in the firm now, and he is that way not just because he's a very, very smart person, but because he really took advantage of a big discontinuity in the market. So he went out there when relationships and relationship banks and lenders or borrowers were, those relationships were being severed, that, there was a lot of big mix-ups. People, didn't know where they were supposed to go. And he came through and said, I'm going to take these people and their deals that are not easy to do. I'm not making 5 phone calls and send it to the 5 guys that everyone knows, but I'm going to go and, roll your sleeves up and find solutions for them and build these client bases. And there are a lot of borrowers with great properties, with a lot of equity in them, that need somebody who will really fight to go find a new lender here or there, new capital source, new equity sources. So this is for mortgage brokers. This is phone call time. This is like shoe leather, burn off your feet. Go talk to those people you think never would answer your phone calls and start setting up lunches.
They'll answer your call today. So good stuff.
Yeah. And they'll remember that you were there to work with them on the hard deals, not just the easy, not just the easy ones.
Great point. Adam Candler, thank you so much. I appreciate it. Listeners, go check out the scotsmansguide.com and go under commercial, and it's Oasis for Capital in the May issue of the Scotsman's Guide Commercial Edition. Thanks so much for listening. We appreciate you forwarding this episode to your favorite mortgage broker or loan officer friends. We really appreciate that. And so on behalf of the Scotsman's Guide, my name is Carl White. We'll see you on the next episode. Thanks again, everybody. Bye-bye.